Hi, Constance. How are you? Mm. Hi, Constance. Can you hear me?
Hello.
Hi.
Hey, is that Kate?
It is. Is that Katie or is that
Hi.
that's Constance talking.
Yeah,
Hi. How are
hi. How are
you?
you? Hi. Sorry, I'm dialing in instead of I'm
That's
still
okay.
yeah. So I'm looking forward to it. And you know what? I was going to reply and say I'd love to be one of the mock judges just to see
Okay.
just to see. Yeah, I'd love to do that if that's not already being filled up.
Yeah. Yeah. What I can do, and just to clarify the opportunity, so it would basically what it is I can send you everything that our real judges are looking at, and it's
Okay.
Brody. And just a second. Honey,
Okay.
I need that in your mouth. Sorry, my child just dropped a lollipop on our couch.
I know it's just the way you said it, but yeah, I thought it was a child.
So basically what we can do is we can give you decks, and then I had each of the founders did like a rough 5-minute video, more not supposed to be polished, but more so they were able to have verbal over their deck. So I can basically,
Okay.
and then there's a score sheet, a really pretty simple score sheet. So I can basically send that to you, and then we just line it up against what the actual judges who are VCs did their scoring and comments on.
Oh yeah, yeah, that would be great. Like what time is it for tomorrow?
The whole event, did I send you the link to it? I'll send out the link. It's at 2 p.m.
Okay.
Eastern.
Oh, that's perfect. Yeah, perfect.
Yeah, and then so I think you've got to sign up for their whole, because they're doing a 2-day set of like full programming for women founders. So this is part of it. I think you have to sign up for the whole thing, but then you would just pop in at 2.
Okay, sounds good.
Yeah, you don't have to go to the
I'm
rest.
gonna. Okay, I'm gonna look out for. Have you sent the email already? I just haven't had time to check everything. But if you have, I'll make sure to.
Nope.
Okay.
I will send it. I can send it like as we're getting into class here, so you'll have it.
Okay, sounds good. Thanks, Kate.
Katie, can you send it to me too? I don't know
Yeah.
that I'll be able to join, but if there's, I would just love to look at it.
Yeah, and you don't need to join. All that's happening, I guess, sort of like day of, is that they're getting the opportunity to pitch again for real. So it'll be a little bit more polished. I can still share with you the results of it anyways. So, and most of it's going to be number based, but because we're trying to keep it sort of simple.
What are you talking about, Kate? I'm sorry, I just came in the middle of it.
Nothing. I just gave everybody an opportunity. We're running a pitch competition tomorrow, and I gave everybody the opportunity if they wanted to, because it's getting scored. So if they want to like practice their due diligence, they can score it themselves, and then I can share with them anonymously the judges' scores. So
yeah,
you know,
Kate,
it's like kind of an easy. We've got it all set up.
Is it okay? Like, we don't have to have it all done by tomorrow, right? It's
no. Yep. I mean, my God, you could get it done over the holiday season. I'll have
that'd be great. Okay, awesome. Thanks.
Okay, cool.
What time is the session tomorrow?
The session is at 2 p.m. And so if you wanted to, I can send you the link for that as well. You've got to, I was just telling Constance, you've got to like sign up for the, AWS is doing 2 days of programming for female founders. It was today and tomorrow. So this is a piece of it. You've got to sign up for like all their programming, but all you've got to do is just pop in at 2.
Okay.
Can you
2
send that?
p.m. Eastern.
Maybe
Yes.
send it to everyone, Kate, so they can practice, and then maybe we can, when
Well,
we come back together in January.
yeah, I didn't. It's a lot of, yeah, it's a lot of. I had put it in our email for
Okay.
this weekend last week, so I was gonna let it because it's a lot of information. If people like weren't necessarily interested, but I think I've already sent it to Kirsty and Christy, so and Alice, and I can send it to I think I heard Constance, Katie,
Yes.
and who else?
Catherine.
And Catherine. Okay, cool. You got it.
Thank you.
Awesome. Thanks, Kate.
Yeah.
How's everyone doing? Last week of class. I also sent Charles's information, the paper on unicorn math. I just sent it just a few minutes ago, so you guys should have that as a holiday reading if you would like to learn a little bit about his thoughts on how can we predict a unicorn. So again, it's he's done a lot of research, so it should be interesting. All right, anybody has any questions from last week? I do have a hard stop at 6, and I think Kate does too today. So let's try to get through our session after we answer the questions, if there is any. And then the guest for tonight his name is Paul Willard. His journey has been from angel to his own fund to a partner at Storm Ventures, and now he has his own fund again. And he's one of the initial investors in Carta. And I really like the way he manages his portfolio companies and the relationships that he has. So he will come around 5:15, 5:20, introduce himself, and then we'll just ask him questions, especially around portfolio strategy management from angel perspective, and how has it changed from where he started out as an angel to where he is right now. And he is focused right now in robotics. Sounds good? All right, let me share my screen. Can you, Kate, can you give me permission to share? Did anybody have any questions from last week? I think last week was probably one of the heavier week in, a lot of math and a lot of looking at the valuation, et cetera, et cetera. So, all right.
Yeah, I probably have to go back and just like relook at the video again, just to get myself familiarized. It was very useful, but I probably have to relook at that and see if I have any questions.
Yeah, and I think I also sent Sky's information, and Kate forwarded it to you guys, so you guys have those Excel spreadsheets to also play around with the and maybe when we come back in January, happy to host another office hour to see if anyone has questions after the holidays.
And also, yeah, and speaking of that, everybody, I actually apologize. What I did mentally with those, so Sky had passed along 2 of his Excel documents. What I mentally did with those is I put them into the new community we put together, and I think I did not email them, and so I will email those, and I apologize for that gap. But we did get those Excel sheets that Sky was really awesome to provide us with.
Yeah,
they're the waterfall analysis, and yeah, so that I'll share them via email. I apologize for that.
Okay, got it. Okay. And let's get started. So today's session, I think we are at a point where we are probably, either have made investment or are getting ready to make more, start investing as angels. But today we will focus on what should be the portfolio strategy, right? What should be your thesis? How do you manage the amount of funds that you have allocated? How do you distribute it? So the example that I'm going to give you is based on my personal journey for the last 8 years. And it may not be the same as far as the amount of the money that the checks that you write, the size of the checks you write. But happy to also talk about other people's thesis if they have put together something that they want to share. I think we kind of talked about it on Friday. If anybody has any thesis that they want us to, look at it as a group and go over, can definitely do that too. So let's go through this, and hopefully we get to have somebody share their thesis. So the biggest thing is when you're thinking about your thesis, right? How do I strategize my portfolio? Like, think about the word differentiation. This is what I think about differentiation. Where do I want to, focus as far as industry goes? What stage do I want to focus on? What is the minimum traction? So in all of these 7 items, I'm looking at what is the differentiation that the company that I'm looking at, where does it fit into and how does it pop out in one of the 7 or more multiple areas of the industry focus, stage focus, minimum traction, investment size, lead or co-invest, target ownership, target return. So my thesis is based on these 7 areas. So what is industry focus, right? So I would start with listing out the industries that you have conviction about, right? So for example, Kirsty is climate tech. Doesn't mean that that's all you're going to be investing in, but this is what you want to focus a lot of your time looking at deals, a lot of your relationships that you're trying to build, a lot of the understanding of how the companies ahead in the game in this particular industry, how are they faring? If they are raising Series A, how, what was their round, what was their seed round like? Or if they're raising Series B, what was their Series A? What are some of the top VC firms investing in this area? Who are some of the people within this top VC firm who are actually looking at the deals and doing the due diligence? So I would definitely try to do a lot of research when I am looking, listing out the industries that I'm passionate about, or do I want my portfolio to stand out, that this is what she stands for. This is the industries that she is interested in, because that's the beginning of building your brand, right? So understanding the industry, and not just what's happening in the industry, but who are the players. How are people investing? What are the round size like? Who are the top VCs, et cetera, et cetera. We talked about some of that in the last couple of weeks. Stage focus. A lot of the angels, angels fall in pre-seed, seed, and up to Series A. So always think that when you invest as an angel, you want to be looking out for 2 to 3 rounds ahead. That's where you're going to get most returns, and you have an opportunity. If you do want to do pro rata, then you have an opportunity to maintain that ownership percentage and do pro rata. Later on, as the rounds get bigger, pro rata gets humongous, and most of the time angels don't contribute post Series A. So if you're a pre-seed, most of your portfolio is in pre-seed, then you want to make sure that you're allocating enough funds if you do want to, consider pro rata. And I'll go through the composition of my portfolio later on, so you have an idea about how do I spread the funds in the pre-seed, seed, Series A, etc. And again, these are guidelines. Even though I have my, my portfolio strategy written out, my thesis written out, from time to time, I come across companies like, oh, that's fantastic. Now I didn't even know something like this, is out there. I'm really interested in investing in this company. And that's the 25% of my fund that, that's where that it comes from. I think we talked about that a few other times. Traction. What traction do you want to invest in? Obviously, the earlier traction, earlier stage, will give you highest return, but also a lot of risk, right? And investing in, as an angel, 70 to 80% of the companies are going to return you, then you're not even going to get your money back. So you really, really, really want to make sure that the companies you do select are, you are doing all your due diligence to make sure that to reduce that 70 or 80% to maybe 50 to 60% probability of failing. You want to also focus on the ones that are winning. How do you put more money into it? So definitely consider putting, having a chunk of follow-on round. But even when you are doing a follow-on round, there is another layer of due diligence that you must go through in order to make sure that this is going in the direction that you want to go into, right? You don't want to put money after. You want to cut your losers fast and really run with your winners. So you really have to make sure that you are not putting good money after bad money because we like the founder, or we think, oh, it's gonna, this industry is just, it's gonna come back. They just had a bad, like whatever it is. I really would like you guys to not cut your losers fast and run with your winners, and really look at this as a math equation and take the emotion out of it. In that I'm still emotional many times when I'm like, oh no, that company fell. I wish I could just help them a little bit more. They're raising, and there are a lot of companies, they are saying that, oh, if we get this much money, we will be at this stage. Or because of XYZ, we are not able to meet our forecast as we earlier thought it would. It was a longer sales cycle, or market is not responding, or we are too early for the market. We just need little bit more money to prove our MVP or get that big customer. Be very wary of that language and stick to your own gut instinct. I think we talked about that also, but stick to the numbers and and do the research about this industry, about the people who are investing in this, and use your network or get on LinkedIn and talk to other investors in that particular company. If you feel that you want to invest in something, but not sure because of the traction or revenue is just not there where you thought it was, but you really believe in the company. So there's another layer of due diligence every time you write a check, even if it's for the same company. Any questions here? So investment size. So this is where I fall in this kind of parameters. For the seed or pre-seed, I invest about $25,000 to $50,000. I have invested as much as $80,000 in one company and $150,000 in another company, but most of the time, 95% of my seed and pre-seed deals, I write a check $25,000 to $50,000. If I were to invest in a Series A company, let's say I didn't invest in seed, but I'm investing in Series A company, I like to invest, whatever my theory is 2 times seed. So if I were to, if I had invested if I were to invest in this company at seed, if I was going to invest 50,000, I would double that in the Series A, even though I may not have invested in the seed stage. But if I were to invest, let's say that I was going to invest, 25,000 or 40,000. If I like the company, I would double it in Series A. Series B, I have done, very, very, very few companies. Like I can, out of 50, probably 3 companies I have done. 3 companies. And then again, I look at 2 times Series A, and that's it. I don't go beyond Series B. I have.
Hey, Dad.
Yes.
A quick question. When you're talking through this and you mentioned like 95% of your companies are in seed, and this particular kind of equation that you're presenting, is that kind of your own equation, how did you get there, or is this a little bit industry standard? Since we're kind of talking about portfolio strategy, would love to hear what's in your brain when you have taken a look at that.
Right. So this is, this is definitely my data. However, I know a lot of angels. I don't know about Series A or B numbers, but a lot of the angels for pre-seed and seed fall into $25,000 to $50,000 mark. And again, if you have a pro rata, and let's say it's a $5 million valuation and you invest 50,000, and so you have 1% of the company, and that $5 million in Series A goes to $20 million in order to maintain that 1% equity, you have to invest $150,000. So from the industry standard, I know the most angels, I also know people who have done less than this, right? And here I'm not talking about syndicates. I'm talking about individual angel investment. Syndicates you can do for $2,000, $1,000, $5,000, right? There is a lot of that too. But this is just as an independent angel investor, what I've done. I've also done this size in Band of Angels, and a lot of the people in Band of Angels, they also are in this price range for pre-seed to seed company. Series A, sometimes, angels form an LLC to, invest at a certain percentage, or, they pool capital together for pro rata. That can be done too. Did that answer the question? Okay. So lead or co-invest?
I think just generally speaking, like I think rounds are getting sort of bigger earlier on. So I think that like the 25 to 50 seems to be pretty common for pre-seed. I rarely see founders accepting less than 25K even at pre-seed. I don't know if others have different experience, but I think that anything below 25K tends to go through like syndicates or, like Angel List or whatever. But I think that's a trend that's happening.
Yeah.
And I feel like Series A's are getting so big that it's actually pretty hard to get in as an angel.
Maybe, yeah. I think I've done few Series A. I've done like 10 Series A myself, but that were sprinkled throughout last 8 years. So maybe now you're right. They're getting bigger and more difficult to get into. And most of the time, the previous investors, if the company is good, they take most of the round. So they have for a new investor to come in, it's a little bit difficult.
Yeah, and there's so many micro funds and like other like new types of VCs also in the space that they tend to take up like whatever is left.
Yeah.
More.
When you say new type of VCs, what do you mean by that?
Well, what I mean, like, there's rolling funds and there's like,
Yeah.
micro funds and there's solo capitalists and there's just like a much broader spectrum to VC than before.
Mm-hmm.
So I feel like they have taken over some of the sort of allocation that was for angels earlier on.
Yeah. So this is what I have done, and the people that I hang out with have done, mostly like Band of Angels. I do a lot of deals with Band of Angels. I do deals with, Venture University, and I've done a lot of angel investment deals on my own too. And this is where I fall into. So lead or co-invest? I've never.
Just like a very quick comment, just because I don't know if it's clear. It wasn't for me when I started. That I think syndicates are great because you get in with smaller check sizes, you get more access to deals. They do a lot of the work, so I can feel more confident investing in some of these companies. But they do charge a carry, so just so you understand that there is like a different structure. Then, like it's not like it's more like investing in a fund, but it's just a small allocation than a fund typically requires.
Should we go over syndicate structure, guys? Does anybody want me to go over that?
Yeah, Jegs, I was sorry, sorry, Christy, go ahead.
I was just gonna say that that's helpful. Like I was actually looking this week or last week, like I've been in like the 37 Angels network for the last year, and it's, as a newcomer, it's been really helpful for me in like learning and meeting people, deal flow, whatever. And that has like an annual fee. So I don't think that there's a carry or anything in that in terms of how they structure that. But I was also looking at like New York Angels, I think, this week, and they have like a higher amount per year that they expect people to spend or to invest. And so I was just kind of curious, like what is especially like ways to break into this if you want to be in several syndicates or angel groups, if you guys have suggestions.
Yeah, so let me go over, Kate, would you like me to go over the syndicates? I think that's.
No, yeah, just kind of to Christy's point, I was going to say, I think it'd be great to go over because it's such an accessible point that anybody here can dabble in, and you can do all of these things simultaneously.
Yeah.
And so I think it would be great to dive into that for sure.
Sure. Okay. So syndicates are called SPV. They're special purpose vehicle. What that means is that, so if you, so there are three types of, the angel, the investment, right? So one is the angel investor, and we'll go with very basic right now. Angel investor, where you write a check, you're on a cap table, your name shows up as Kate or Jagriti, whatever, and the amount next to it. That's an individual angel investor making an investment. And the angel groups like Golden Seeds, 37 Angels, Band of Angels, they charge, if you are part of an angel group, they charge a membership fee, but your name shows up as an individual investor and the amount you put, but you pay a membership fee on an annual basis. Second way to invest is an angel investor. If the company says, no, we don't want to invest, we don't want to manage a lot of the individual investors. So what I've done also is that we form an LLC, 5 or 6 angel investors from, I've done this with Band of Angels, 5 or 6 people. We still invest, 25,000 or whatever our minimum is. But we form one entity and we pay the fees for that, LLC, $800 or something on an annual basis. And then that LLC is on the cap table of the founder. So there's 2 ways as an individual angel investor to make an investment. Now, syndicate and a fund is another one. So the fund, you already know that it's the initial capital that goes into the fund, and then the GPs have full authority to make decisions on where to invest, how much to invest, whether to have a follow-on rounds, the term sheet, we talked about the liquidation preference, everything, the GP decides that. And LP is just like an absentee owner of, or absentee participant. They don't have, many of the times they know where probably are, what type of investments are going to be happening, but they don't know the individual investments as they happen. And I'm now talking at a very generic level. Some LPs are very involved, some GPs are very involved also with their LPs. So, and then that is about 5 to or 10 year life cycle of a fund. And over the 10 years, you pay 2% management fee and the min and 20% carry. So what that means, that 2% management fee on an annual basis, you pay to the GP to run the business. And at the end, you get 20% carry of, any 80, you give 20% carry to the GP and you retain 80% of the profit. Now, 2% of the carry, 2% of the management fee is actually a loan in a way, because it all gets paid at the end when the fund is dissolved, right? Assuming that the fund was successful. So you do pay upfront, but at the end you get it back, right? Assuming the fund is successful. And 80% of the growth you get, and 20% is retained by the GP. So that's the fund. And the syndicate is per company or per startup. So one, or it could be the cohort. So a Y Combinator cohort 200 has a syndicate, and you can invest in the Y Combinator cohort, and it gets, whatever it is, it gets divided according to, to all the companies in that cohort. So you can do syndicate as a cohort, or you can also do syndicate individually. So when you do syndicate individually, you'll say, oh, I am syndicating XYZ company, and we are raising $100,000. I am the lead on the syndicate. And as a lead, you usually put, it varies, but sometimes, most of the time, 30% of, 30% of the syndicate total that you're raising. And then the rest are people are putting 1,000, you set the minimum. Usually the minimum is about $2,000 or $1,000. So you can go anywhere from 1,000 to, whatever you want. Obviously, there's other parameters, like if it's oversubscribed, then you may get pulled back. You may not get your full allocation that you wanted. And if it's if it's undersubscribed, then you can put more if you wish. But say with syndicate, there are two types of fees model. One is you either, same as the fund, you pay 2% management fee and 20% carry. It works exactly the same way, but instead of a fund, you get to decide, this is the company I'm passionate about, so I want to invest in this particular company. So you have more control over the decision-making process on where your money goes, because it's, a syndicate, right? And syndicate usually are 5 to 7 years, just like a life cycle of a company. There's another way people do syndicate is, instead of doing 2% management fee, they say, okay, in order to set up a syndicate and to have it alive and do all the accounting, legal, finance, is going to cost us $15,000. So then it is divided among everybody, whoever is investing in a syndicate is divided depending on what your amount that you invested in. You get prorated the fees too. And at the end, when let's say that syndicate, the company is successful, then whatever profit is left, 20% goes back to the lead investor or the syndicate owner, and then the 80% goes to the goes to you. So those are the basic differences. I hope that made things a little clear.
Jags, so if you as are the lead in the syndicate and you invest 30%, so you would get 20% off the top, then you would get 30% of the 80%. Is that right?
So for the 30% of the fund, there is no carry. Yeah.
Okay, so you get
I get 100% of my 30%.
Sorry, say that again.
I get 100% of my 30%.
Okay, so you essentially get 50%, and then the last 50%.
No. So let's look at the numbers now, right? So let's say that the syndicate is $1 million, right? I'm raising $1 million, and I've invested 300,000. It's 30%. So the remaining 700,000, right, is whoever is in the remaining 700,000, they will pay me 20% carry. But for the 30% of the money, there is no carry. So I don't charge myself carry.
Got it. Okay.
Yeah. So it's not 50%. It's actually so. And then let's say $1 million grew to 5 million, right? So you basically take. And we are not going to look at the fees. Let's just do pure math. 5 million minus 1 million, right? So the remaining $4 million, right, is the growth. And out of $4 million, 70% of $4 million is what I get carry on. Make sense?
Yep. Thank you.
Any other questions? so again, you know, as Kirsty pointed out earlier, it's getting harder and harder to have 1% at a seed or pre-seed stage because the valuation is really high. However, if your valuation is between, you know, a preference is between $3 and $6 million, like we talked about, I think a couple of sessions ago, that if you're looking at companies, their valuation is between $3 and $6 million in pre-seed or seed stage, then you can still do 1%, you know, 1 to 5%, depending on, you know, where you are in that seed stage check size. And I would say you always ask for pro rata, right? You don't have to do it, but you always, if you want to do it, you always should have that pro rata rights. And for angels, the target returns we would like is around between 10x to 30x. Does that happen all the time? No, you know, most of the time it's one, you know, 2 to 3%, if you're lucky, of the companies, or you know, will reach this 30x valuation. So this is the example that from my portfolio, right? So first of all, you should never invest more than 5 to 10% of your overall portfolio, right? Angel investment is a very risky. Sorry? Did anyone have a question? Angel investment is a very risky thing, and you know, you should not do you know, more than 5 to 10%, maximum 10% of your portfolio, your total portfolio. So in this example, let's say that it's $1 million, right? I took my own example, and I invested, you know, about 40 portfolio companies. I've done 50, but that includes syndicate and you know, YC cohort, and you know, etc. But 40 individual companies I have invested in. 50% of it is seed. I retain 20% for pro rata, and I retain 20% for Series A. So what does this mean, right? In the example of $1 million, 5 to 20K per company in the pre-seed stage. This is what I have done in this is the first 5-year portfolio, and now I have updated it to 25 to 50K in last 3 years. So this is my first portfolio that I'm sharing with you that I had started in 2013, that I've invested in, you know, back then. The pro rata, I've invested in 8 companies out of you know, out of 40. In Series A plus, make 2 to 3 companies, as I said earlier. So you want to come up with an equation that sits well with you, right? There are other people, other angels, they don't do any pro rata, and they don't do any Series A. They just do pre-seed and seed, and they literally invest in you know, 70, 80 companies in the first 2 years of allocating funds, and then that's it. And then it's like a fund. After you have allocated all that money, then what you do is you focus more on portfolio management. You focus on, you know, figuring out where those companies are going and providing the support that you need. So that's one strategy. So the other strategy is that a lot of people say, I'm only going to do 4 companies per year, and then they have done 4 companies per year for last 10 years, like a clockwork. They do 4 companies a year. So in order to invest in 4 companies a year, they're probably looking at 70, 80, 100 companies, right? For them to, you know, invest in four companies a year. Their thinking is that I want this game, you know, I want to do this forever. So if I continue to invest in 4 companies, about $25,000 to $50,000 every year, then I am going to get returns on the other side, also more or less, you know, periodically. It's not going to come all at once, right? So they are phasing it out, and they've been doing angel investment for the last 12 years, right? So they do 4 companies a year, like a clockwork. So when they do get, exit, then it is also kind of spaced out. I mean, there is no magic number, right? But if you look at 5 to 7 years for a company to come to an exit event, or maybe 10 years, then they know that they're pacing that out pretty consistently. So those are the 3 strategies that my friends and the other angels that I know are using at a pre-seed and seed stage. Happy to would love to hear from others what they do. Okay, do you have any insights on this?
No, I mean, I think kind of what you're alluding to is I think this is, there are so many factors that go into this, such as your own time, how involved you want to be in the companies, how much you have to spend, what's your budget every year, how risky, I mean, would you rather have 10 companies at lower check sizes or 4 with higher? So I think to your point, Jags, like this is part of the learning process.
Mm-hmm.
And because I guess they're going to take a couple years, it's kind of all over the board. One of the things that I do think is helpful in understanding this more is having this conversation with more experienced angels. Like, what is your math breakdown on your portfolio and why? It doesn't mean you have to do it, but I always think that's a really interesting question. Like every VC fund, they all have different fund models, right? They all think that their strategy is going to work and it's going to, so it's a really interesting question to have.
Yeah, but VC fund, I would really caution against using a VC fund model for your own portfolio.
Oh, yes. Sorry. I wasn't suggesting that. I was saying that when you're thinking about portfolio strategy, you can break the math down in so many different ways. And so VC funds do that. They all have different ways they're breaking down their own math. And I think similarly with angels. So I just think this is a great conversation topic while you're learning.
Yeah. And the reason I would say caution against the VC fund is because VC fund is run by, they have a different structure. It's run by a GP. Usually they don't have more than 1%. I think by law it's required they put 1% of the money in the fund. But most of the money, so
it's not by law, but it's best practice.
Okay. So, they are focusing on getting, and that's why a lot of the VC companies are, really interested in getting in at the later stage, the growth stage, because they are interested in seeing that accelerated growth. So I would say, and again, I'm generalizing this, mission is to get as much growth out of a company as possible in the shortest amount of time. So, because that's their business model. While angel, this is your own money. You got to really make sure that you have conviction towards the, what you're doing. You do have a strategy. You do have a, kind of a structure. Not just legal structure, but also how do you want to invest? If you were to invest in 4 companies, what kind of deal flow do you need to look at? Do you need to look at 10 companies? I would say no. Do you need to look at 50 companies? That's a good start. 100 companies, then we are really at a good place. So you really also want to make sure that you do have, not only you have the money and desire to make an impact, but also time, because to be successful. Because if you're not successful, your what are the chances that you're going to continue to do this? Probably not that high. So that's why we all are here, to make sure that and that's the beauty. And I think that's the beautiful part about being an angel, is that you kind of control your own destiny and your own time, and versus, syndicate or a fund model.
Yeah, Jags, really great. You just reminded me of something too on the time side. Is one of the interesting things I like to try to look at as an angel investor is who the other investors are and what their check size into that company is versus their average check size. And mostly I mean the firms. So this is going to come maybe later stage, but if you take a look at some of the VC firms that you're investing alongside of, and let's say a really excellent firm puts in a check size that's on the higher side of their average, that probably means that firm is actually going to spend a lot of time with that company. And so when you're talking, you as an angel investor, you're not going to solve all of the problems for a portfolio company. And so being able to also trust some of the success metrics, right, exactly. And being able to trust some of the success metrics and the, the people that are the other people surrounding your portfolio companies helps you actually manage your own time pretty well.
Yeah. Christy had a question in chat. I just noticed. And the question is, I've heard that investing too early on can mean that you're not getting the best terms. I've invested solo in family and friends round and seed rounds, and with syndicates with other VCs leading rounds and the syndicate's lawyer reviewing our docs. I really do prefer investing early on. Do you have any advice on timing? Preferences of seed series A over friends and family. I think, my 2 cents on this, that I hardly go with family and friends round. Even though I may be friends or, part of the family, I always say, I'd be interested in going at coming in at a seed round for 2 reasons, actually 3 reasons. One, I understand what they're trying to do better. And it's no longer an ideation stage, even though some pre-seed are still ideation, but because of the valuation are increasing and more money is coming in, most of the time in the pre-seed or seed stage, they already have an idea of a product or some kind of customer conversations they've had, et cetera, et cetera. Second is I really also want to know that how did you, what was your journey like from friends and family to this? What has, want to spend time with the founder knowing that and asking those questions, because that's important to me to understand. Can this founder or the set of founders execute, right? They started out with something, are they able to execute and raise a fund from strangers, not just from family and friends, right? And then the third thing is, as you pointed out, the terms, right? The terms are more on a, like a not cookie cutter, but the terms are familiar to me, because I have invested in a lot of pre-seed and seed stage round. In family and friends round, I always say that that's not a part of my thesis. So, but I'm happy to look at this when you are further in your journey. That is my preference. Anybody else want to add? And we can ask guest speaker this question too. Yeah, Crystal,
I agree with that, Jax.
Sorry.
Hi, it's Jory. I was just saying that I have a very
you are very raspy, Jory. I don't think it's your throat. I think it's your microphone.
I just got a new one, and clearly it's not working very well on this mute for now until I figure it out. Please go ahead now for me.
No, can you type it up and we can?
Sure, no worries. I'm just figuring out my microphone, so don't wait.
Can anybody else hear her, or is it me? I just want to make sure it's not me shutting.
No, I can't hear her either.
No, Jory, it is a little, yeah, it seems like a little, yeah,
Raspy. Okay.
can't quite
Sounds
hear
good.
ya.
Christy, yeah, I think this is the $1 million question, right? For how to organize the data and docs post investment. We are going to look at Affinity. I put in a call with them a couple of times, haven't had a chance to follow up, and this is my fault because I'm moving and I just don't have, I didn't get a chance to talk to them the time that they proposed. So for sure, we're going to invite you all in January for the demo for Affinity. Or right now, all I do is I just do Google Sheets. I have a folder. Within a folder, I collect all the pitch decks for the companies that I have invested in and what stage. I organize them by the stage. And then I also have my IRR calculation spreadsheet, which says that this is what I invested in and at this date, et cetera. And also the third sheet is the contact information. And I always make that part of my trust documents because I invest through my trust. So I want to make sure that in case something happens to me, my girls at least know who to contact for this company. So that's how I organize it. It's not really very fancy, but this is where I collect only the information, only the companies that I have invested in. Another thing that I started doing in last, I gathered all the data like about 7-8 months ago, beginning of COVID. And I looked at all the data that the companies that I've invested in, companies that have exited, companies that have failed, and the companies that I passed on. I was very close. So I don't look at all the companies that I passed on, but the companies that I was so close to making an investment, but I decided against it. So that's the fourth bucket. And then I went and I saw where those companies are. So most of the time, my gut feeling for passing an angel investment was right on, but there were some gems that I missed, right? We all are going to miss them, right? And we all are going to make, decisions that are not the best. But so then I started plotting them, not the companies, but the founders. And I came up with 7 characteristics of founders that I really liked I didn't even, so that's the first thing I did. I said these, without looking at the success of the company or where they were, I looked at the founders first. And I said, okay, these are the founders. These are the 7 characters. I rated them, right? And then I looked at all the where the companies are successful, et cetera. And to my surprise, kind of surprise, not surprise, is that the founders who I thought were executors, operation minded, coachable, had insights into the industry they were building in, not just the experience, but the insights. And we talked about a few of these things, were in the top right quadrant. And the others were, scattered around. But the ones that the successful companies, they were all had similar characteristics. So now I'm plotting more and more and more of those data in the 7, characteristics, the founders. So that's just something fun I did, but I thought it was very interesting.
Would you mind sharing with us at some point those 7 characteristics? That's awesome.
Yeah, I'd like to. And I did that, and then I haven't touched it in 4 or 5 months, but your questions reminded me that, I did that. I should take a look at it. So I'll definitely share that with you guys. And it would be so interesting to also get information from you guys, or individually you can do this, or as a group, because I think at the end of the day, I have a lot of faith in people than obviously technology and market, but people are where it is really for me. The founders, I mean. All right. Okay. Any other questions that I missed? Okay. Sorry, Jory, if your mic works again, you can tell us what you were thinking. You always have a good idea.
If you can hear me now, all I was saying is I agree with the friends and family. I think sometimes it's fraught. And I mean, advising a lot of companies that were working, first operating off of friends and family, sometimes, especially if those friends and family are not experienced investors, there's all kinds of weirdness with the terms and the control issues, and it can get kind of messy.
Yeah, yeah. A friend of mine who just started as an angel investing, and we kind of lost touch because she went to Africa for a couple of months. So she came back and she goes, "Oh, I invested in this so and so company because somebody said it's a great company." I said, "Oh, really? Tell me more about it." And I got to see the term sheet. Term sheet was total bullshit. Total bullshit term sheet. She lost $35,000 in about 4 or 5 months, and the guy is not even responding or anything. She had no idea. She thought it was some legal document came to her, and she's like, "Oh, this looks good. This looks legal enough, right? I'm going to sign it." He signed it, and it turns out that it was, he gave her 80% discount on terms. Who does that? So it's always a good idea to, before you write a check, at least check with someone in your community or on LinkedIn. If you propose that, it would be, I'm sure somebody will question this. So thanks. I'm glad your mic is working. All right. So some of the strategies, right? For managing your portfolio, and I think we are now kind of moving from the strategizing your portfolio to managing your portfolio. Get access to the term sheet early. What I mean there is that if you're interested in a company, get the term sheet early, right? If you can, right away, along with a pitch deck, because if the terms are not friendly, why should you go and do the due diligence? I mean, you should still do the due diligence if you want to, but to me, if the terms are not according to my thesis, I don't want to waste time. So get access to the term sheet early. Build relationships with companies, right? So when I say with companies here is like, before you even invest, try to find out more about this. Try to, when I go for demo days, like this is pre-COVID, used to go for demo days, always hang around afterwards and talk to the companies that are you found interesting. Not that you're going to write a check right away, but you found interesting. Learn more about them. Learn more about what's not in their pitch deck and what they didn't share when they were on the stage, right? Try their product, right? See a demo, whatever it is. Hang out. Don't, demo day to me is just the beginning. You're going to hear everything you want to hear in a demo day. It's the things that you didn't hear. That's what you should be after. And that's when you hang out afterwards, you're listening to the other people, and you are, listening to other people having conversations with different founders, or you're having conversations with different founders. I definitely start building relationships with the companies before you even, if you have an opportunity. And now, all demo days are virtual. So that doesn't happen that often, but if, when we do go back to our normal way of being, definitely in person, hang out and, see if you can get some more information. If you like the company and you really think this is a great solution and it fits your thesis, reserve capital for follow-on. All right, you don't want to unless part of your thesis is no follow-on, then it's fine. But if you do want to do pro rata, reserve capital for follow-on, and if it's a great company, it makes sense. I've done quite a few pro ratas in food companies, food areas, because they're very operational expense heavy companies. So, but they're doing good. So, you know, I always want to support in the follow-on round with extra, if I can, extra investment. Kill your losers early. We talked about that, right? Don't throw good money after bad money. Everyone makes mistakes. We all are going to make mistakes, and we all are going to have missed opportunities, right? That's the name of the game. Is to have the odds on your side by doing the due diligence, by making sure you look at enough companies. Losers will identify themselves faster than the winners. Don't try to talk yourselves out of saying, oh no, maybe he had a bad day, or maybe this is a really good founder. I don't know what happened to him or her today, or market is not there. You know, be really, you know, black and white about things. And if there are enough, what do you call, enough signs, sit back, reflect, do your due diligence, do your research, and you know, honor that what you're feeling or what the conclusion that you come up with is probably true. Help entrepreneur. Yes.
On the loser stuff, you know, like, when can you say to an investor, to an entrepreneur, a founder, like, hey, you know, I don't want to invest anymore. In fact, I just want out, buy me out. Can you say that to them at times, or can you, like,
well,
or how do you have that conversation of I'm out, I'm done, you're a loser? That, I mean, not that bluntly, but you know what I mean.
You can say that with your inside voice, but never outside, but never with the outside voice.
Right.
And I know you know that. I'm just playing around with you. The first thing is, you're never going to get your money out. So most likely, you know, asking that is just going to make you feel bad, because the angel investment game is that once you invest, the liquid events happen when there is an exit event, right? It's not like, unless a founder is like a friend or a family and saying, okay, I'll give you the money from, you know, from my own personal, just transfer the shares. And that has happened too. So how do you have that conversation that just say that I'm not doing follow-on rounds? It's not in my thesis. They don't have to know.
So you just, so it's basically when, like, if a founder comes to you and says, I want more, I need more money, you can just say no. There's no.
Well, I won't say no right away, right? I would try to understand. Maybe there is a real, you know, the product is good. You know, maybe there is something real. I wouldn't say no but if I do my research, my due diligence, talk to enough people and sit back and look at this and look at my portfolio, right? And then you have to become a bird. You have to look at from the bird's eye view that, okay, what are the companies that are in my portfolio, and how is this going to helping this company or not helping this company going to fare against everything else? That's when you want to make a portfolio level decision. But after doing the individual level research on why does the founder want money, and you can ask these questions, right? It's like, oh, what happened? Can you tell me more? I'm curious. And get him talking. And the one thing that I see a lot of investors, including myself, I've learned this lately, including myself, we tend to fill in the silence. When you're having an awkward conversation with the founders, don't fill the silence. Stay with the silence, because that silence will let you have a peek into what's happening in the founder's life. So if you say, I'm curious, what's happening? Tell me more about it. Quiet, dead silence. Let the person open up and say, because when we try to fill that space, we don't hear, we don't listen, and you really want to listen, and you really want to hear what the other person has to say before you say no or yes or whatever. So I don't know if that question, if I answered your question, but
no, that's super helpful.
Okay.
Yeah, no, that's good. Thank you.
Jags, I actually have a follow-on question there. I'm so bad at killing losers. I don't know. I'm like one of those eternal optimists. And what I wonder is, I mean, especially at the seed stage, there's often issues of product market fit. There's a lot of things that, you know, that can go wrong, and it doesn't mean that the company is going to go wrong. So I'm just curious, like what, other than the obvious, I think that there's some probably obvious examples, but just from your past experience, like what were some reasons that you just said, all right, I'm cutting bait here?
Yeah. Remember we went over financial statements?
Well, right.
Ask to
Yeah.
see their bank
That's a good one.
statement. Ask to see their cash flow. Ask to explain their burn rate. Ask what kind of salary they are taking. And they should take a salary. I'm not saying they should, you know, starve and not have but they should not be paying themselves $250,000 versus 60,000 is a pretty reasonable salary. 70,000 is, and that's what they should get, right? So ask to look at that financial statement, and that's data you can't ignore. And then ask questions. Ask if you can, you know, would it be okay if I talk to your customer? I really want to understand this problem. And you say that this customer is, if we have this feature or something, we'll sign a deal next year. Do you think I could have a conversation? And obviously depends on your check size again, right? If you're going to put $5,000 more, it's probably not going to happen. But if you're putting 100,000 or, you know, whatever, 50,000, and it's a significant amount compared to the other investors or what he's asking other, you have every right to ask those questions. And you're not asking something, you know, out of ordinary, right? Again, you know, as an angel investor, your mindset should be that this is a business. This is your life's work. Whether your life's work is to have more, you know, support women founders or underrepresented founder, this is your life's work. This is a business, and we have to treat this as a business. I'm sorry if I'm aggressive, but I've learned a lot in my life. And so this is what you're getting after 9 years of angel investment. The first year I was writing checks to everybody. I was just so
It's
delighted.
helpful. I think that being an entrepreneur, I just tend to be very optimistic, right? Like they'll turn it around.
Yeah.
They'll
And
figure this out.
sometimes they can, right? It's not like, so understanding their day, what keeps them up at night. Ask those questions. What keeps you up at night? And then stay quiet. Listen.
That's good advice for women in general, Jags, too.
Yeah.
You always want to fill the silence, right? And make excuses for people or answer the questions for them, whatever. So giving us permission to ask hard questions and to listen and all that is very, very helpful.
And remember, we have a purpose, right? We individually have a purpose, but also as a community of women, we are doing this because we have a higher purpose.
Yeah. One thing I'd say too is this: while you're doing this entire process, these are the things you can also be asking of your fellow angel investors as you're growing your network too. It's not just what made the successes, but what have the failures been as well. Like I can share with you some failures. I've lost money before, you know, I mean, and I shape my strategy now moving forward based on those. And I think, you know, I am somebody, I will say, I'm probably further on the spectrum of asking a lot of people. I have sort of a larger advisory board for Women 2.0. I've always been that way, but this is the reason why. It's like Jags has sat here. Jags, how many deals have you done?
54.
54 deals. I mean, there's something in there. And every other person that you meet who's done 20, 30, 40 deals, like just pick their brain on this stuff, you know? Ask for half an hour of their time of some of the people who are willing to, and a lot of them will be, because as Jagrati said, like, if this has become somebody's life work, oftentimes there is some sort of, mentorship and advisory component in that. So for whatever that.
Yeah, and Kate's absolutely right. And there's always somebody ahead of you, and there will always be somebody behind you. So while you're looking forward, also, this is what I believe. I extend your hand in the back. Somebody will, meaning offer help, because you also have so much experience, and you are gaining all this experience as you move forward. I'm hoping there's an army of women angel investors coming after us. And we are kind of like the comrades, we are getting the area ready so they can have a network and a support and a community, and ask those difficult questions and honor what they learn in their own way of doing business and their own life's purpose and work. This is much greater, I believe, than all of us. It's just to me, we are creating something really amazing here, and there are a lot of communities like this all over the world, right? And that's where it's really good that people are I don't know, I lost my thought. Anyways, you guys get this idea. I'm really passionate about helping women become angel investors. So anyways, any other questions? All right. Okay. So then what? After you have your strategies, right? You have your strategies in place, and then what? How do I add value as a strategic investor? So there are a lot of different ways angel investors, or the fund managers and the syndicate leaders, and the platforms like Seed Invest and Republic and PropelX and Let's Venture add value, right? And most of them are at a different, fall into three categories: money, connections, so capital, connections, and customers, right? Help me get more money, connect me to people who can be advisors, I can hire, so the connections, and customers, help me get more customers, right? So those are the three things that most entrepreneurs are needing help in. They may not need help in solving that defect that they're found, and whatever. But these are the overall high level, these three things, if you could remember, capital, connections, and customers. And these are some of the ideas that I have. So this is after making an investment, right? You want to be helpful, and you want to help be part of the journey. You want to be helpful and part of the growth. Sometimes they will come to you and ask you, and sometimes they don't. How do you approach them, and how do you be part of something that you obviously believed in, so you wrote a check, but also how do you be part of the journey? The way I do it is I tell them that these are the three things that most entrepreneurs need. Like I told you, customers, connections, and capital. This is what I can do in, X, Y, and Z. This is what I can help you with. If there is anything I can do more, please don't hesitate to ask, but please keep me in mind for these three things. And then I just walk away, let them do their own thing. And I expect them to give me a quarterly investor report. So that's something that doesn't happen most of the time. So every quarter on my calendar, I spend a day or two emailing all the entrepreneurs, say, how is it going? It's been 3 months already. How is growth? Where you would love to hear. And a lot of times I think, oh, great. Thanks for the reminder. We need to do an investor update, right? Sometimes I don't hear from them, but then I hear from them like in a month, saying, oh, we were really busy, but this is what we've been up to. And very rarely I don't hear at all. And if I don't hear at all, I let another month pass by and then I call. Then I go on their LinkedIn. Then I find out who the other investors are on their cap table. And then I literally am stalking them. Because if you are going to take my money and not give me any update for 6 months, I want to know why, right? So keeping that on side, these are some of the things that the strategic investors, you know, as a strategic investor, you can be a strategic investor by adding this value. So validate technology and help with adoption. So a lot of times they're looking for early adopters, or they're looking for people to test their product out. So I'm always like, oh, I'll try it. I'll do this. Or, you know, it doesn't cost me anything. It doesn't, but it gives me a glimpse into what they've created. And I'm happy to do that because I get to also know, oh, this is what they're up to and this is what they did. And I'm obviously passionate about the product. That's why I invested in, you know, to begin with. So I'm happy to help with that. Provide key early revenues or help increase revenue, right? Again, the customers, right? So how can I help you make introductions, you know, to companies? Like if there's a SaaS company or enterprise company, oh, you worked at, you know, Cisco, or you worked at Google. Can you, do you know anybody in your network you can help, you know, help us connect with? And I've done that many, many times. And because of LinkedIn, they also know who's connected to who. So sometimes I get emails saying that I see this person who's you know, who's really an expert at what we are trying to get. He's connected to you. Do you mind making an introduction, right? So again, connections, right? Potential cost savings, free physical space. So if you know, sometimes like for example, what do you call it? SAP gives free space in their, well, they used to in their Palo Alto office, they have the entire floor for people to come and work, right? I mean, it's obviously pretty, you know, secluded, and, you know, but they give that free physical space to people. So that translates into cost savings. Falcon X, which is one of the incubators here, they give free space to any entrepreneur who wants to just come and hang out there for 3 months and need a place to just, you know, park themselves. Investment capital, introduction to institutional and strategic investors, new clients or other strategic partners. People, right? You're hiring. I want to hire employees. I want to get board members. I want to get advisors and mentors. Do you know anybody in this area, et cetera, et cetera? And ultimately, introduction to potential acquirer or people who are doing M&A kind of consulting. So I have people in my network that I've introduced to companies that are saying, okay, we are at a really good place to find out if we can be an acquisition target. So this guy, you know, Naveen Batra, he comes in and he works with them, and he's an M&A partner. So, you know, things like that. So again, you know, this list can grow and you can add a lot more things. The point here is that every entrepreneur needs 3 things: connections, capital, and customers. So how are you going to help them with that? And also only if they ask. Or if I see something in the report that makes me wonder, and then I approach them. I think Paul is here. Kate, he just texted me. And this brings us to.
Yep, he is.
Okay. You can, if you're okay, you can let him in, but continuous deal ranking.
He's hanging out.
Yeah.
Hey, we are just finishing up, Paul. Just give us a few minutes.
No worries. I'm enjoying it.
Thanks. So continuous deal ranking, right? You really want to make sure that as you are building a relationship with the investors, with the founders, as an investor, if you are going to make, your pro rata investment, or if you are looking at a company, other company in that space, I say you always continuously doing the deal ranking. And these are the 7 things that I always ask myself before I make, write another check for the same company, whether it's in the same round or, a company in a similar space. what's the market opportunity, right? We went over this a couple of sessions ago, growth of target market and penetration needed to hit revenue goals, right? Who are the team, who's in the team, board members, advisors, what kind of tractions, right? What kind of traction they have, the milestone timeline, what are the terms, that's important. Who are the co-investors? And what can I add what value can I add to this? And what are the exit opportunities? So once you are done doing your due diligence and you write your check and you are in the company as an investor, even then I continue to just do deal ranking, if I were to invest again, or if I'm just curious where they are. These are the 7 questions that I ask. Obviously, the terms are not going to apply if I'm just curious because they're not raising. But I'm even if I don't invest in this particular round, I want to know who, how did they raise the money? Who were the investors, et cetera, et cetera. And that's it, guys. Do you guys have any questions before we welcome Paul officially? All right.
I will say, and this could actually be a question for Paul, but Christy, you did have an excellent question. I got logged off, and of course, I've lost my chat. But Christy actually had a really good question in the beginning of our conversation, and I said, that's an excellent question, probably for Jags, but also probably for Paul. And Christy, I don't know if you want to resurface that, but I do not have it in front of me because I lost my chat.
Sure. Yeah. And Jags kind of answered it, but it would definitely be interesting if Paul or anybody else has any insight. Like I've heard before in my limited experience that investing in friends and family can be less advantageous than in seed or Series A because of the terms. And I've invested using safes in both, I guess in friends and family rounds, and I've done it by myself, and I've also done it with like an angel network. And I think I felt safer with doing it with an angel network because I know more eyes are looking at it, more experienced eyes are looking at it, network's lawyer is looking at it. But I've just heard that the terms, like you don't have as much leverage because there isn't like a VC leading the round. So if you have any insight, like I've kind of been convinced from Jag's comments and some other people's that I should maybe be really interested at friends and family and wait until a seed round, but any insight you have would be helpful.
Well, welcome, Paul. You're muted.
Thanks. Yeah, thanks a lot. Wow, jumping in on that. So I didn't hear anything that came before. Friends and family can be fine. A lot of times if you're getting a 20% discount, uncapped or with a cap that's reasonably not going to be applied, I would argue that friends and family under those circumstances might not be priced. The risk might not be priced in so well yet. But a lot of times friends and family rounds are sort of have very reasonable caps that will be exceeded by the seed round or the next money in. And in those cases, you could get in early.
But you don't know that future happens.
Well, you kind of do.
I think that's where we want to dig in. How do you know?
Because you know what market is for a good seed right now. And so you know that by the time they get to a place where they can attract, what I would call seed investor or pre-seed investor, whatever you want to call it, like their cap, depending on how much traction they have before they get there. And you should have an idea of how fast they're going to get to how much traction when you're talking to them super early. Their cap's going to come in between like 4 million at the lowest end for that pre-seed seed kind of round, institutional, and 10 maybe at the high end if it's really like a strong, heavy seed with a lot of traction. And so like based on a rough, and for an individual company, I think I can tell better than that. That's a pretty wide range. But so if you're outside of those boundaries for that next round with institutional coming in, they're not going to get investment because they're just not going to look like, well, when we're managing a portfolio for our funds, we need check sizes and valuations to be in certain ranges for our portfolio theory to work out right, like I'm about to talk about. And we just can't get too far outside of those boundaries or it messes things up.
Okay. Well, welcome, Paul. Would you like to introduce yourself and tell everyone about you? I know Paul for a while now. We've been friends and we've had a lot of amazing conversations. But Paul is a robotics expert, and I'd let him tell about him a little bit more.
Sure. I have a kind of a very non-standard background. So I'm an engineer who worked as an aerodynamics engineer at Boeing in the 90s, and then got my master's degree at Stanford and graduated in 1999, right in the middle of insanity. And I switched to startups. And so I just stayed, basically. I got my master's degree and never went back to Seattle. And I worked for 4 startups over 15 years. They were all insanity growth. 3 of them IPO'd. And then after 15 years of loving that, but only being able to be a part of one startup every 4 years and only being able to be a part of one team of people, that's really what motivates me, Jags knows. Every 4 years, I tried angel investing with an early stage fund. Venture capital investing with an early stage fund, with the idea that I could be part of more than one team every 4 years. And my goal was to be somehow involved with, one company a year or something that was on that insanity growth track, because I'm just so addicted to those people and working with them, hiding in the foxholes, or rolling in the mud like a pig, however you want to look at it. And so in 2013, I switched I had done a few angel investments previously, and I started managing a fund. My first fund was called Subtraction Capital. Mm-hmm. I invested, it was a $20 million fund, so very small, very early stage, $200,000 checks in, 1% of the fund. That's a fairly concentrated approach, as I'll talk about soon. But I invested in 2 robotics as a service companies. One's called Zipline. That's actually a prototype Zipline hanging from the ceiling. And they deliver blood and medicine, initially in Rwanda and Ghana. Although it looks like they're going to do some COVID vaccines in North Carolina. So they're in the US now too.
Oh, wow. They got the FCC approval.
They have 1 level of FAA approval. We're working on the next level now. But and then the other one's called Cobalt Robotics. And this blue one on the ground, I'll back up just for scale. This is a Cobalt robot.
Yes.
And it's an indoor office security robot. But one of the 4 companies that I worked at was Atlassian. Mm-hmm. And so I feel like I got my PhD in SaaS at Atlassian because we were pretty far ahead of the curve. And I feel like we invented a lot of the terms because we were living them and learning them every day. And so beyond the robotics investments, I've got other SaaS invests. We were angel investor in Carta as well. So Carta and Zipline are carrying our portfolio right now.
Yeah, those are your unicorns.
Yep. We have some other unicorns, but we messed up. We were early investors and not very smart, and we allocated our portfolio badly. That's why I'm actually a good person to talk about portfolio.
Yeah, but I thought of you. So tell us more about that.
Yeah.
What do you mean by you messed up?
I made some expensive mistakes. So we invested in a couple of companies. We felt like it was our first fund. And so our portfolio of companies didn't have older siblings from earlier funds. Mm-hmm. And also we've been working in startups so long that we had access to later stage deals where they would let us in. And so I think we did 10 of them with $100,000 each. So $1 million, 5% of our $20 million fund went into these deals. And the mess up is because some of them have done really well. Like Collective Health is one of them that's doing really well. Those actually, we have more than 2 unicorns.
Oh, wow.
But,
okay.
But the other unicorns aren't going to drive any value for the portfolio. They're not going to put any returns in my investors' pockets. And that's why I say I messed up. So if we were going to come in at that late stage, we shouldn't have been putting in a $100,000 check because
a lot more.
it's too little relative to our portfolio. Whereas like I look at Zipline and Carta, we got over $1 million into each one of those. So we got 7% of the portfolio. We built up to that. Our first check-in was 500 on Zipline. So 2.5% of the portfolio. And on Carta, it was, there wasn't any room in the rounds. Our first check-in was actually only $50,000.
Wow. And so you obviously matched your pro rata. For how many rounds did you invest in?
So we're very lucky, and I was glad to see you talking about being a strategic investor and helping with the 3 C's.
Yeah.
Because we got super pro rata in every company that we invested in. So not only did they say you're pro rata right as you can invest this much, the CEOs, Henry and Keller in that case, and some of the others as well, came to us and said, hey, we're gonna do a round. Your pro rata is this teeny tiny bit, but how much do you want?
Mm.
And we were smart enough to plow in hard on Zipline and Carta.
Yeah.
Yeah, and actually Zipline, our investors, we ended up following with significantly more money than even, I think we put 1.3 in from the fund, about the same in Carta, it turned out. Mm-hmm. And then we've got another, I think we have another 15 million that's outside of the fund where we let our investors follow them with that super pro rata. And that was 100% because of value add. And the beauty of it is we only had a $20 million fund, so 15 million. So for an angel, the equivalent would be if you were so helpful that you were building syndicates to follow at late stage. Mm-hmm. And our fund was only 20 million. We put another 15 million into our 2 biggest winners outside of the fund with the same investors in the fund. So the equivalent of a syndicate. I mean, it was a syndicate. We literally called all of our investors and said, we want to put money in Zipline. They're raising again. Do you want to put some of it in? How much do you want to put in? And we've been so helpful to the founders that their motivation was for us to own as much as possible. They weren't letting anybody else into these rounds. So the fact that we had been helpful gave us access that no other investor in the Valley could get.
Yeah. So when you say helpful, right? I mean, there is a balance, right? Especially as an angel investor, you know, when you're writing $25,000, $50,000 checks, what are some of the things that you should and should not do as an angel investor when you do want to add value? And, you know, keeping in mind the 3 C's.
Yep.
Yeah.
So one super easy one, if somebody's sending a monthly update, just send something back. Something, so they know that you read it and you're out there. You would be surprised of the 50 investor updates an early stage founder sends, they might get 2 replies.
Wow.
Now, if you don't have anything helpful to sort of ask, mm-hmm. And it's an ask. It's, hey, would this be helpful to you? It's not, I'm going to do this. They would perceive it as, I'm going to do this to you. No. Or even though you would probably write, I'm going to do this for you, but don't write, would you like me to pursue this? Would you like me to ask so-and-so about speaking with you?
Yeah.
So it's always ask.
Yeah. Like what we did with Safeway, with Zippity.
Yeah.
Yeah. But it didn't happen anyways, but we kind of asked and yeah.
So it's always ask, and it's always, if you don't have an offer for help in there, that's fine. You can still send back a great job on this or bummer about that. Just like something to let CEOs a lonely job at these companies. And they just appreciate knowing that you're with them, honestly. And so I try to reply to every single investor update that I get, even if it's only with 1 sentence. And if I don't have a lot to add, it probably will be 1 sentence because I don't want to waste their time.
Yeah.
But I just want to let them know that I'm there. And then beyond that, it's the same thing. It's just always offering help, not cramming it down their throats.
Yeah.
And then I never ask them to build a deck for me, ever, outside of that first investment in, mm-hmm. because I don't want to waste their time.
Mm-hmm.
I do ask them to take whatever they're using as their regular day-to-day reporting that they don't have to spend any effort on and walk me through it with them.
Mhm.
And yeah, so that's just an efficiency thing. I don't want to. So many investors are perceived as a time drag and a time suck, and part of it's because you have to be dog and ponied and walked around.
Yeah.
And so to the extent that you don't have to be, or that things can be efficient, casual, easy, like lunch, if they have free lunches, is like, it's sort of free time, right? Because you can catch up with them casually.
Yeah.
The same thing
How do you,
for happy hour after work.
yeah. So how has it changed for you with COVID, right? I mean, I know that you used to spend Monday morning with the Cobalt and Monday afternoon with Zipline. So you used to have this chunk of time that you allocated to spend with and you used to just go there and sit there. And if anyone has questions, if I remember correctly, anyone has questions or anyone, you're part of a landscape. You're no longer an investor, the person on the other side of the table. You're part of the landscape. You're part of the team. How do you do that in COVID times?
Well, I tried to make I would spend a half a day typically every 2 weeks with the company, sometimes every week in the beginning, and then tapering down. But I would try to make that half day when they were having their all hands. So I tried to sit there and that was a way to get even more information than the investor update.
Yeah.
Again, without burdening the CEO at all.
Yeah.
They were doing the all hands anyway,
Yeah.
And so I still go to their all hands.
Okay, got it.
So I'm still there, but I'm not in the room with them like I used to be.
Mm-hmm.
And so it is harder. It's harder to make new
friends, so to speak. Other free ways, you can still hear me, right? I'm trying to switch. I'm hoping headset sounds better. Other, free ways to get involved with the company and help the people there without getting in the way are attending things like, sometimes they'll do a monthly sort of happy hour for the team members, and you might be able to just join. That they're already spending that time away from work, so you're just joining it. That's all.
Mm-hmm.
And then you'll just naturally meet people, and if you meet people and you have something to offer, great. And if you don't, you've met a nice person that's probably really hardworking and smart at the startup you invested in. No foul.
Yeah.
And so I can't do that anymore, not during COVID, but they're not doing that, in fairness.
Yeah.
I still did get invited. Yeah.
Oh, sorry. No, I'm sorry. I thought you were done. Keep going.
I still did get invited to their holiday parties. That's all I was saying.
That is important. That is important. I'm glad that's still happening. I have a question along this line. Because it sounds like you do spend a lot of time with your portfolio companies. What are some, and I have a couple of things that I have seen in this realm, but what have you seen is the type of help or support that your portfolio companies need? And what I mean by that is, does it tend to be business help? Does it tend to be networking? Does it tend to be, in my particular case, one of the things I've found is that actually a lot of founders and I actually had one founder specifically tell me this, they actually would really like founder support, like almost founder coaching. Like I get these connections everywhere else, and I just actually want to spend, an hour every month talking to somebody about being a founder, So I'm just curious from you, when you're talking about your time,
You popped on mute, but I think it just clipped the last word maybe, so we're okay, right? Yeah, no, that's a great question. So I will almost always make sure that I know the head of recruiting, because you have great networks, as I do, from operating typically. And so recruiting always wants people. And so I can almost always help recruiting. I can almost always help. So when it comes time to fundraise, I'm very helpful just because I've sat on both sides of the table so long. And so if you have that to add, great. But like practice pitching and constructing a pitch deck, but also prioritizing as you're getting, like when you're 8 months out of fundraise, you better be prioritizing the things that are going to help you raise the Series A, and like throw everything else off the boat, you know? And so prioritization and just keeping that focus in. And, you know, I build a Series A deck with a founder the day after they raise their seed, always. It'll change, the story will revise, but I don't care. We're building the Series A deck the day your seed is closed, literally. And that's just to keep you focused along the way, so that they understand the priorities, right?
Yeah. No, that's great advice.
Other areas can be company specific, because one team of co-founders is really great at product and technology, but terrible at distribution. And one is really great at distribution and technology, but not great at product. And so those tend to be the three stools, if you will. And they're almost always stronger in one than the other. Sometimes they don't have a finance person anywhere in the house for quite a while in the early days. And so just helping them build what looks like a normal finance. Also, silly things that I still haven't blogged about, but I keep meaning to, like getting your target list of investors for your Series A together. It sounds simple, but I can't tell you how many times I have suggested to people that they go to Crunchbase and find investors in their sector and get a blacklist of people, you know, conflicted people that are already invested in a competitor, and then see how many times the same names come up. And this sounds simple, but it doesn't occur to everybody, and I'm not surprised, because they just haven't done it before, you know?
Yeah.
And so just like creating that Google sheet, and what goes on it, the name of the partner there, who's your contact person there, what's the current status there, you know? So yeah, fundraising almost always, recruiting almost always. Now I go a step further with recruiting, but as an angel, it might be a little harder to do. I'm not sure. Because I will actually, if they really are fighting hard to recruit some rock star that they want to get, I will interview that person. And by interview, that means wine and dine them. So I will take them out under the guise of an interview. And then I'll tell them how great the company is and why I invested, and I will help them land that recruit. If you recommended somebody or introduced somebody or brought them in, you may be able to play that role too. And like, you close down somebody who produces for a company, wow, you're the best friend, for real. Because those are the people that are going to drive the company, you know?
Yeah.
Well, plus now your network's in the company. So like when somebody who used to report to me at coupons.com is now running marketing at a startup that I invested in, like, not only do the founders love me, but going down the management team, they love me too, because they worked with me before.
Yeah.
So it's how powerful recruiting is. I can't, and it's just an easy one. It's just an easy one to give your name to the head of recruiting and saying, connect with me on LinkedIn. And if I'm connected to somebody, go get them, right? And if you're just having trouble with a role and I can help you brainstorm, I'm available for it if you want it. Again, it's the ask, don't push yourself on people. So yeah.
How often do they take you up on that?
You know, it's funny. Each company like has one or two things that they like. I am their guy. But they're different for every company. So it's whatever latches, and I don't worry about it. But yeah, almost every company hits me up for something.
Yeah. Do others have any questions? I could ask Paul a lot of questions.
I never finished portfolio if you want me to.
Yeah, sure. Go ahead.
I did mention that if it's too small a percentage of your total portfolio, it doesn't matter if it's really successful, it won't drive your returns. And
Right.
that is true. And so everybody's, I'm sure, familiar with the power law, the idea that one company is going to outperform all the rest so well that they won't matter much. And so the goal of most portfolio theory is to maximize the probability that you'll have a very good return. If you wanted to maximize your possible return, you would dump all your money in Uber at the friends and family round. But that's a too risky approach to realistically take for anyone. And so if you're maximizing the probability that one of your companies is going to return so much that you're not worried about the others, then the conversation quickly becomes about N, the number of investments in the portfolio. And you need to make sure for each of those investments in the portfolio, they have the potential, if they become a power law winner, to return your whole fund.
Right.
And so N, in financial terms, N depends on beta. So sort of the variability of outcome returns and the probability that you'll get those high returns. And people have different models. I will say if you're doing enterprise, your N can probably be lower, can probably be more concentrated. And it's why you see so many funds that focus on enterprise. Because concentration leads to good returns. If you're 500 startups, not just to pick on them, so apologies if anybody's associated with them, I love them, but 500 startups, I would argue, is a good consumer investing approach. So the wide net, because if one of those companies takes off and you're literally 1/500th of your portfolio were there, which is not what they did, by the way, but let's say 1/100th, because they advocate ends of like 100.
So they give actually 5%, $100,000. So 5% is their equity that they get for $100,000.
Yeah, they tried to boost.
No matter what it is, though. No matter what it is.
Yeah, they definitely try to boost their equity, and all accelerators will do this. Try to boost their equity relative to the dollars that come in.
Yeah.
But their 500 startups anyway, their thinking is that they have to invest in 100 to ensure that they get at least 2 unicorns. 2 unicorns is the most likely. 1 is possible. 3 is also possible. But they're trying to ensure that they don't get less than 1, because if you don't get the 1,
then you're not returning even 1x.
Right.
Yeah.
Unfortunately, that happens a lot. People are always shocked at the percentage of venture capital funds that don't even return 1x, but it's shockingly high. I think the last time I looked, it was above 30%.
So if that was the case, why are the valuation going higher and higher at a pre-seed and a seed stage? I mean, is there a correlation between the failure of venture fund, failure meaning 1x or lower, versus the valuation that's happening, going higher and higher at a pre-seed and a seed level?
So valuations don't have anything to do with returns, interestingly. As far as what the valuations are a function of market. And so if you've got a lot of money that wants to invest at early stage and you have a small number of high quality companies that are attracting all the investment, valuations will go up. And if the opposite is true, valuations will go down.
I guess my question more was about like micro VC funds, right? Then more and more VC funds are now starting the early stage part of it, like Sequoia has it, Excel has it, whatever, right? So are they trying to make up for that less than 1x in their overall portfolio by investing into early stage and seed stage companies?
No, the big ones, the big dogs put out the micro investments just to get the first look.
Okay.
And so they're buying an option. They could care less if they make money in the micro or not. They could lose the whole micro fund and it won't affect their return.
So it's like an option strategy.
Yeah, so don't ever think of it as a signal. Well, you could think of it as a signal a little bit. They wanted to buy an option in it, but they're not looking at that as the way to drive their returns. It was interesting enough to buy an option.
Yeah, got it.
But I encourage companies that I invest in not to take money from any of the bigger funds that they might approach later. So
And
I
the-
encourage them not to do it, because if Sequoia doesn't follow that seed money that they put in,
it's
it's
bad reputation.
it's a negative signal to the rest of the market, because the rest of the market will go, wait, why didn't Sequoia follow it? It's not good enough for Sequoia. Why would I put money into it?
Yeah, got it. All right, continue. Sorry,
Oh, that's okay. And so speaking of Sequoia, so Sequoia's N, by the way, for Series A, and based on their track record, is somewhere about 35, mid 30s.
Okay.
And so they would argue that if you're not as good an investor as them, you need a higher N. And if you're a better investor than Sequoia at Series A, you can do a lower N. Other ways to make lower N would be to be more enterprise focused. Because I think beta is lower for enterprise than it is for consumer, especially at early stage.
Yeah.
And so conceptually, the danger if you dilute too much is you'll own $100,000 in collective health like I do. And no matter how great they do, and I think they'll do great, it's just never going to drive the return for my fund. It doesn't matter much, right? My fund is at 5x right now. And I think the collective health portion is less than 1% of my fund's value, you know? And that's what happens when you put 0.1% into one company. So that's too much dilution. Too much dilution in the portfolio sense. That's too high an N. And we were mixing and matching, that was the mistake, really. Because in companies like Zipline, we were doing it right. We were putting 1% in our first check of the fund. And then when it did well, we got more in. In fact, we got up to 6-7% of the fund in the winners.
Yeah, that's what another thing we talked about. Don't put bad money after good money.
No.
Or sorry, good money after bad money.
Good money after bad is fatal. But
so now you have another VC fund. How are you looking at things differently? And tell us.
We're not going to do that. We called it our strategic portfolio, the $100,000 in 10 funds. We're just not going to do it. They don't need older siblings. It's okay.
Okay.
And if they need older siblings, I can use the ones from my prior fund. I don't care, whatever. But they don't really need them. And so we're trying for actually a very low end because we only have 2 partners. And we do want to be very involved. So we're going to be enterprise for sure. So enterprise robotics as a service. We're looking at an N of 24. I would love N to be a little bit higher, honestly, but we would have to add a third partner. We'd have to raise a bigger fund. It's problems, but and so if I'm angel investing, though, I'm trying to do the same thing. I'm trying to say, here's the total dollars I'm going to allocate to angel investing. And so I want to drop 1% into at least 20 different companies to have a reasonable chance that one of them is a unicorn.
Right.
And then if I see the one that's going to be a unicorn early enough and I have the ability to, I'm going to like pile in as much as it's risky to go much beyond 7%. As obvious as Zipline and Carta sound right now, they were scary when we were putting 5% of our fund in a single chunk, you know, and they should be scary to an angel investor if they're doing the same thing.
Yeah.
But that's sort of a reasonable and concentrated approach, an N of 20 as an angel. You can go all the way up to 100 if you like consumer, because that's maybe where your background is or your passion is. That's fine. You should definitely invest where you have knowledge and passion. And I would advocate that 100's an awful lot, though. Maybe more like 50. So some bounds on there, and then a pretty even allocation in the early days. So if we did 25 investments also out of Subtraction Capital at 1% of the fund. So that's 25% of our portfolio on initial check.
Wow.
Right. It's not that much, right? And then we piled in on the ones that we thought were the winners, and half the ones that we thought we were winners we were wrong on. So that's just to give you an idea, right? And thankfully we did catch the 2 winners. But and I would argue that that's probably the right way to go, is because you're better off piling on too many, and half of which don't end up winners, than missing the winner.
How many companies would you say you looked at it before you invested in, I don't know, 10 companies in your fund, or whatever the amount was? Like, what is your ratio, if there is a ratio?
Some people do keep track of ratios.
Mhm.
I am much more focused on how high a quality an intro can I get. And I would rather talk with, so I want to do 4 investments a year as a fund manager. I would rather talk to 4 companies and they are all spectacular because somebody that I've known forever walks them into me and says, oh my goodness, this company's going to make so much money. And likewise, by the way, the second half of that signal that I want is they're telling some founder, oh my goodness, you have to have this investor in. This is the one that's going to help you. So I want it to be both ways. But that said, I find a helpful framework for me when choosing to pull the trigger or not to assume this is the only investment I'll ever make for the rest of my life. In fact, assume I'm going to go to work at the company, because you can only work at one company at a time, right? And so I try to run the process like, okay, is this the company I go to work for? Or do I think I'll see something better in a month or 2 that I'd rather wait for? Because I can only invest in one. And as much as I can, I try to forget that I'll ever make another investment after that one. And so for a year for a venture capitalist is a pretty good clip, actually. A lot of them do 2 a year. As standard. And that's just, they have more partners in a fund, so they can do 2 a year and still get to the ends that they want. So classically, a 4-partner fund doing 2 investments a year is 8 investments a year. 32 is N for the fund.
Right.
That is why most like classic funds have 4 to 5 partners to try to get to that N of 35 or 40, just like Sequoia.
Yeah. So is that the magic N? 35, 40 for enterprise?
I mean, Sequoia isn't just enterprise, but 35 to 40, if you're a good investor, is a pretty nice number. Okay. If you're early stage and you have friends at Sequoia, they will beg you. They've said this. Some of my friends there have said to me so many times, more swings, take more swings, take more swings. They don't like how concentrated I am. They think it's too risky. So at 25, they think I'm too concentrated.
Got it.
And a lot of successful angels are the same way. They're trying to get N up there, 40.
Yeah. Interesting. Well, it's always a pleasure to talk to you. I think Angel, did you have a question? Sorry.
It wasn't a question. I just really liked that tool or method, I should say, of saying like, you know, would I work for this company for a full year? Like, yeah, I recently kind of took a similar thought process, and but I don't know that I was as explicit with myself as you just articulated it, and I think it's an excellent way to really see whether your gut tells you like yes or not.
You nailed the other thing I love about it. It's that when you're picking a place to work, you do rely on the big brain, the subconscious one. Yeah, and I was reasonably structured about it when I looked for work. Like 3 of the 4 companies I work for didn't IPO because I'm such a great operator. I'm fine, but so are lots of people. 3 of the 4 IPO because I was a great picker. And I was a great picker because I trusted my gut. And I would make the Ben Franklin with the positives and the negatives. And I would do as thorough a job as I could on all that. I was very structured about it. It was like the 4 T's: team, TAM, traction, tech. And then when I finished and I had perfected my Ben Franklin, I would walk it over to my wife, because her gut's even better than mine, as I've learned.
Usually women's gut is better. No.
It's all right.
You have 2 daughters. You should be happy.
I am. and we would review it together, because showing that Ben Franklin to somebody else, there's something about showing it and talking it and communicating it to somebody else that also adds to its richness and its value. And then when we finished, I would literally tear it up into pieces and throw it in the garbage can. And I would wait at least one day and one night before I made a decision to join the company or not. And I do the same thing now with investments.
That's interesting. You
And
still do Ben Franklin, huh?
I still do the Ben Franklin. I have an investment memo template
Yeah.
now that I use also, and I'm happy to send it out to you if you want to forward it to everybody.
Yeah, that would be awesome.
But
Yeah.
please don't share it broadly, because you don't want startups coming in like just ticking all your boxes with made up data.
Yeah.
So, but you're welcome to look at it yourself.
Yeah.
But please don't share it. And then but yeah, I still do the Ben Franklin. I still tear it up, and I still wait a day to give my gut time to process after I did the front brain analytical stuff, you know?
I didn't know that about you. So I learned something about you. I thought I knew pretty much a lot about how you do the investment, but that's excellent. Yeah. And we talked about that, Angel, we talked about, trusting our gut, I think in second or third session. So I'm glad that we are coming, and that plays a big role in its portfolio strategy and as a value add also.
Yep. So I try to formalize it. I try to create a place where my gut gets to work.
Mm-hmm.
It has space in my process, so to speak.
Well, Paul, thank you so much. If nobody has any questions, we are just a minute over time, and I want to be respectful of Paul's time as well as everyone on the East Coast. So mostly everybody's on the East Coast except you and me, Paul.
Okay.
So we are.
No. You've got some West Coasters there.
Oh, we do. Oh, yeah, that's right. Kirsty is there.
Oh yeah.
Sorry.
I'm Bay Area.
Yep.
Oh, Angel, are you in the West
area?
Coast too?
Yeah.
Yeah.
Oh, I didn't know that. I thought you were in. Oh, okay. We have to meet after COVID.
I spent a lot of time in New York and the East Coast, but yes.
I feel like after COVID, we should just all rent a house somewhere.
I know.
I'm like, oh my God. Oh, lovely. Paul, thank you so much for coming. This was an excellent session.
Yeah,
thank you.
Thank you, Paul.
Thank you so much.
Thanks, Paul. We'll chat later. I'll ping you.
Sounds good.
Thanks again. Bye.
And thanks everybody else. Thursday is our last session. We're gonna be talking about branding, but we're also gonna spend a little time together. Quick summary of the course, saying hi, and come with wine or coffee or water if you want to also. So looking forward to closing out on Thursday. Yeah. Oh, what's that, Angel?
That's one of my investments.
Let me see.
Love it.
Yeah. It's the I invested in the B2B company that infuses this company's beverages with CBD or THC.
Oh,
so this one's my favorite.
Sorry. Is that actual? Hold up. Is that actual tonic?
No, it's lemon lavender. Yeah, it's social tonic, but it's not actual tonic. No, it's CBD, THC with sparkling lemon lavender. It tastes a lot like a gin and tonic, but with like next to no calories.
And where did you get it from? Safeway or?
No, because they can't sell THC products. But
that's right. That's right. I forgot about the THC. Yeah.
I had it delivered from a female-founded company who's actually a competitor to one of my other investments, and I'm still buying from them. They're called Sava, and they're basically, just a commerce and delivery platform. But I invested in Ease.
Wow, Ease.
Yeah. And the company that infuses this company, the product that they created is a tasteless, colorless, odorless, water-soluble THC. So there's only, I think, 2 products in the market in California that they aren't infusing. But yeah, I decided to go for the B2B approach on that one because building up, an entirely new brand and a new market where there's a high level of consumer education is super costly, right?
Yeah, absolutely.
But it tastes great. So
Love that approach.
yeah. And it's only two.
Oh, what a great approach. That's awesome.
Yeah, it's only 2 milligrams THC and 4 CBD. So
Yes,
you know,
Jory.
it's mellow.
Yes.
I love that. Jory had to hop off, but she and I are both gin and tonic
Yeah, I love 'em.
women. So that's why we were homing in on
Yeah.
that. So that's very
It tastes
interesting.
just like a good gin.
Cool.
I have the gin coming in the spring.
Angel, would you mind sharing a link? that I can
Katie,
go
I'm
to?
sorry. What? Gosh, we have
Hold on,
such
yeah,
a
let me
good
pull
group here.
My Irish craft gin is coming in the spring to the US.
That's right. Okay.
So
Okay.
I'll supply you guys.
When you say my
I
Irish
love
craft,
it.
are you developing that, Katie?
I'm an investor and on the board, and I'm taking a big role in doing the US launch. So
Oh, wow. Love it.
Wow,
Yeah.
wow.
it's
Yes.
Okay, I am
Cool.
sharing it here. And if you buy anything, all you have to do is say, give them the code ANGEL and you'll get 20% off.
You are the best.
All right.
I'm moving on a Thursday, so this weekend this is what I'm drinking. After
Yeah, I'm telling you.
I am ordering.
Me too.
Mhm.
Thanks, Angel.
For both Angel, for both you and Katie, by the way, next year, for Women 2.0, I'm thinking of doing a couple, like a happy hour series, and during each, it would be a women or underrepresented owned beverage of some sort, like large category. But this could be interesting both for that gin and Angel for this drink as well. And I'd love to like have the founders in and do a little social hour too. So this could be very interesting for that. I love it.
I'm up for that.
Yeah.
Cool.
I'm already ordering it.
Awesome. Okay.
Thanks, guys.
Good luck
Yeah,
with the food, Jags.
Bye, everybody.
Bye.
Bye.
Thank you.